You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear.
Hey folks, welcome back to the Shoe In Show. Thank you for joining us again. Today I'm joined with Matt Priest. We're co-hosting today. Matt.
Yes, sir.
How are things?
Good, man. How are you doing?
Doing okay.
Got back from Portland, man. Kick-ass events. Four awesome
amazing.
events.
Yep. Still a little tired. Still recovering a little bit. But
and you have three little kids. It's like,
three little kids. That's
there's
right.
no respite no matter where you go on this planet.
Listen, no rest for the wicked, my friend. And that's okay.
I thought it was weary. Wicked. That's a new one.
Yeah. Lot of energy. But more than that, really good content and discussions and networking. And so we'll unpack more of that. But if you've never been to our events in Portland, it behooves you to go, because it is folks chatting about what's happening now and sharpening each other on strategies. But also what was great about conversations on both days was really around the future. It really was around like the innovation and things that we can look forward to and how we're going to accomplish that. Like what are the tactics that are going to get us down the road? And those conversations you don't have normally because people are at their desks doing their job and works harder than ever, right? Like we got more getting piled on top of us until the robots come and save us. That's what's going to be happening. So it's nice to have time to sit down and actually chat face to face with folks about what they're thinking about or hoping about for the future of product and the industry and consumers, et cetera. So across the board, really fascinating to be able to have that opportunity.
Yeah, I agree with you. It's always just the city is just every year since COVID, it's gotten better and better and more lively. And you can say that about a lot of cities, but Portland took the brunt of COVID pretty hard, and particularly the downtown. But as you and I were bouncing around the city, we both commented to each other privately just about how the city is improving. There's more activity, there's more business, there's a lot more people in the restaurants, and which is awesome because Kick City, USA, sneaker capital of the world, it's a really cool city, really neat people there, and it was on hard times for a while, but it's great to have the opportunity to bring people. We had pushing 300 people for our brews and shoes. To have that many people come downtown again and hang out, I think the city's appreciative. They were there, they were very appreciative, but also it was cool because Portland's given us so much as an industry. It's great to give back.
Well, we had around 60 to 70 folks who flew over from the East Coast.
Mm-hmm.
And we had 10 or 15 people fly over from Europe.
Yeah, that's crazy, right?
For the event, just for one or the other of both events that we had. So, if you're sitting there in the Midwest, you're like, well, I don't know. Like people are like, it's the gathering that matters because people are going back with how to do their jobs better, and how to add more value, how to be a leader in these spaces, and how to make a difference in their company. So anyway, I think there'll be more of that. Honestly, I think just chat with somebody who went. You don't have to listen to us pontificate. Anybody who went, chat with them about it. They'll tell you all about it. So today's kind of conversation, I guess, is more focused around like what's happening with the economy, right? We recently had a rate cut, and kind of wondering how that's going to impact companies' bottom lines or long-term capital allocations, how it's going to impact kind of consumer spending, if it's a warning sign that things aren't all hunky-dory out there as we think it is. But also we've got some new sales data that are coming in from the summer, I think, and it's kind of giving us a picture of we're doing okay, but maybe we're treading more water than we think we are. Maybe we're bailing more water out of the boat a little bit. I don't know, Matt. It's a strange time. It's hard to say one way or the other definitively about what's happening.
It is hard to say because there's data points, and I think this is where we bring in FDRA economist extraordinaire Gary Rains. But Gary, to Andy's point, there are data points, particularly at this era we've been in over the last year or so, or maybe even longer, where you have, we use this analogy probably ad nauseum, but this glass half full, glass half empty. And there's something, if you're an optimist, there's something out there you can point to, and you're like, oh, unemployment's low, or the jobs report was great. And if you're pessimist, you're like, oh, credit card debt's like through the roof, and people are, spending money they don't have. And it's really hard to know where you find ourselves. And oftentimes, even as we're finding with the job reports that have been revised downwards, upwards of 1 million jobs, we find out like after the fact we were actually in, negative territory, or sometimes we find out after the fact we're in positive. So as you join us for another riveting episode of Shoe In, Gary, where are we on the glass half full, glass half empty analogy these days?
Yeah, sure. Hey, gentlemen, it's good to be back on Shoe In. Indeed, it's a glass half full, half empty kind of thing. And I hate to extend the cliche that, there's a million shades of gray going on here. Economics is certainly not one of those precise sciences that you can point to and say, oh, here's the number to 4 decimal places. It's kind of, I think Ben Bernanke had described it a bit like blindfolded in a dark room trying to feel your way around the furniture. And every now and then the furniture gets rearranged, and it really complicates your day when you think you know where all the furniture is in that dark room, and then suddenly it's all rearranged on you. That's exactly what we're seeing going on here. The furniture got rearranged last week. That is, the Federal Reserve had cut interest rates for the first time in about 4 years, and it cut its benchmark federal funds rate, cut it from like a 23-year high. That's all well and good, and really that had been expected for some time. But kind of the recent surprise that's come up here the last maybe 2-3 weeks before the Fed's rate cut was that it would be as large a rate cut as it was. They trimmed 50 basis points, 0.5% off its benchmark rate, and that's it's not unprecedented, but it's fairly unusual to see them do such a large cut after having really, they stood pat for almost a year and didn't tweak rates at all, and suddenly there's this 50 basis point cut that has a lot of us kind of scratching our heads going, wait a minute, what do they see? What do they know that the rest of us don't? The Fed tends to move more like in a stair steps, kind of baby steps up, baby steps down. And this was not a baby step. This was a pretty big drop, this 50 basis point cut. So yeah, it has a lot of us kind of scratching our heads going, what's around the corner that we're not anticipating, right now.
Well, the Fed isn't not in a bubble, if you will. They like to act like they are, right? Kind of like the Supreme Court, these untouchable agencies that are critically important to our system. While at the same time, a lot of the criticism leading up to a lot of criticism in general around the Fed is that they act too slowly and don't do enough in either direction, right? They don't jack rates up quick enough in response to in response to an economy that's overheated. And then they also conversely don't ramp them down quick enough in order to tamp down inflation and get people kind of spending again. So was the surprise for you, and then we can get into like the ramifications for an industry and for a consumer, but was the surprise for you that 50 basis points? Do you think that's subject to some of the criticism that's out there that Chairman Powell hears it, or is there a data point I kind of have these visions of like an old school movie where the Pentagon has this, or Mission Control where there's like a wall of TVs and they're checking is there like a Chairman Powell wall of TVs where he's looking at all these data points and there's some secret data point we don't know that he has access to, or maybe he's just overly sensitive to the need to do this quickly because the soft landing was pretty soft, but it wasn't without its turbulence and bumps. Yeah,
maybe a little bit of both. I lean a little more that Adam Smith with the invisible hand, that the market knows best. He certainly knows better than I do, and arguably better than Chairman Powell does. And we've seen the bond market has been telegraphing for some time that we needed a pretty steep cut in rates. And, of course, it came to pass. I think if you would ask me a month, maybe 2 months ago, I would have said, no, 25 basis points is on the table. But the bond market the last couple of weeks has been saying, no, it's likely to be much deeper, at least a 50 basis point cut. In fact, the Fed is, I think, only beginning its downward series of stair steps now. And I think we're likely to see several more sizable cuts, 25 and 50 basis points at each of the next couple Federal Open Market Committee meetings well for the next year or so. So a year from now, rates are going to look very different than what they look now. And I think we're seeing that kind of predicted with what's going on in the bond market.
Bond schmonz. We all want equities. We all want our 401k to boost up, Gary. Don't bring your data sets and truth to the Shoe and Show, my friend. We don't want to hear it. Maybe. I think, I think, let me ask you about this. And we've talked about this before, but like, how accurate are our data models? Like, I know it's very good that we can compare employment in 2024 to employment in 1975, right? So the models are good for comparing historical averages. But when I just feel like we're in like this next economic age, and I'm just wondering how our models are holding up to help us better understand, like, we're living in the gray, and I get that, but are our tools living up to where we can better measure where we're heading or where we're actually at this point in time? Do you think we need better modeling at this point?
And certainly, as an economist, I think there's always room for better modeling. Getting into economic modeling, the error term is still way too large. You can always get better. That having been said, it reminds me of a politician had said some time ago that capitalism was the worst form of the way to run an economy, except for all the rest. Yeah. And I think it's kind of the same issue here, that the models right now are the worst they can be, except for everything that was used before this. So it's the best it can be for now, but it's the worst it's going to look years or decades down the road from now. And we're seeing again, it's that shades of gray that the economy does not move in a straight line. It tends to be pretty erratic, whether you're looking at the labor market, or you're looking at the equities, or you're looking at housing. It tends to be erratic, and there's no smooth, sinusoidal, trends to these graphs at all. They tend to be, more like an EKG. They tend to be, bounce around really in an erratic fashion.
Can I ask you about your opinions or how economists look at, and I forget the exact number. I think it's like $7 trillion in reserves by boomers or retirees that are sitting there on the sidelines. Like, maybe it's in the market, but whether it's liquid or not, there's all this capital that's sitting there in the U.S. that at some point may go to the next generation, right?
Sure.
That may be passed down. Is that like I look at debt, and I'm always concerned about debt. But in our long-term outlook, our population isn't really declining for a long period of time. We have, plenty of immigration coming in, whether you like it or not, plenty of folks coming in to take jobs that may not be filled without them. And then we've got this I guess I'm just asking, over the next 20 years, with the amount of money we have, with the amount of innovation we have, and with plenty of labor still coming into the market, or with AI innovating out, certain processes that are non-valuable, how do you see our long-term play as a country?
Yeah, you're exactly right. We're on the cusp of seeing the largest generational transfer of wealth on record. As we see, boomers, more and more boomers entering retirement, and frankly, getting, grayer, just like me. As we see that happen, and as boomers age, you're going to see more of that wealth passed to Gen X and millennials, and on down the line. And I wonder a bit how that is likely to play out. As maybe a lot of that money is set aside in passive investments now. Is it going to stay passive, or is it going to be more of the the Robin Hood generation, to where everyone thinks, Bitcoin is going to do this today and that tomorrow, and there's going to be a lot more, active trading? I don't know. I'll leave that to the pundits, but I think that is certainly a key long-term variable that will be in play. And I think you're exactly right. Talking about debt, both household debt and national debt is just at unprecedented highs. And I was not surprised, but maybe a bit disappointed to hear, both candidates, presidential candidates in the latest debate, didn't mention debt at all. It's not even on their radar, and they're squabbling, bickering about other secondary issues. But I think national debt has the potential to be a huge issue the next couple decades. And it's an unsustainable trajectory. And eventually, as I say, eventually someone's got to pay the piper. And right now, that generational can is being kicked down the road, to subsequent generations. It's way too much debt for you and me to pay now. And frankly, I think for our grandchildren to pay now, it's the per capita amount is just absurdly high. So how that shakes out, I think, will be another key factor, along with that generational transfer of wealth the next couple of decades.
Let's set the debt question aside for a moment, because you're right, it's super serious and no one is talking about it. The Republicans are just totally giving up on spending and debt as an issue as a party. But, as we look at the Q3 2024 Shoe Executive Business Outlook Survey, Gary, there are two data points that point to, in my mind, how both companies and consumers will be impacted by the rate cut. And I want you to help me put kind of rubber to the road on this. Sure. Capital expenditure outlook dampened somewhat between Q3 and Q2, where more of our respondents saw a decrease in capital expenditures over the next 6 months than the prior quarter. And the amount of increase went down as well. And more people were like, kind of status quo from a business perspective. Obviously not, anticipating rate cuts, but not knowing exactly what that would look like. So my first question is, let's start at the business level, then we'll get down to the consumer, because we have data around that as well. What do you think? Do you think that rate cut and subsequent expected rate cuts will provide some incentive for maybe that capital expenditure number to bump up, for companies to be thinking about maybe doing some investments in some places that they wouldn't have otherwise because they have access to cheaper capital? What are your thoughts of the impact on business?
In short, yes. I think that while the sentiment survey was done before this latest rate cut, and certainly before a lot of that sentiment that the rate cut would be as large as it was, I think that, yes, in subsequent surveys, I think we're likely to see that issue of capital investment reverse course, seeing more, not only the current rate cut, this 50 basis point cut, but similarly big cuts coming up the next couple of months. I imagine we're likely to see that reverse trend. Again, I always caution, as the cliche says, respect the lag. That typically when a rate cut or a rate increase happens, it can take the Fed says 12 to 18 months to really permeate the economy. So on the one hand, everyone does that knee-jerk reaction when rates go up, go down, the same day. That's all well and good. You might see a change for the prime rate right away, but really before it permeates the rest of the economy, it could be a year and a half before it finally trickles across the broader economy. And it's like thinking the economy is like a aircraft carrier that does not spin on a dime. It takes a whole lot of water to turn that aircraft carrier around. And we're just seeing the first initial movements in that turn going on now.
Well, in that same report, the shoe shoppers said that the outlook, or I should say the respondents said their outlook for shoe shoppers actually was about the same, although the very weak, next 6 months, shoe shoppers would be kind of in a very weak position. That bumped up slightly over the prior quarter. What is the ramification for the consumer specific to the outlet? It's interesting, like our respondents are saying, hey, we're not going to probably spend that much money on capital investments, but I think that our consumer is going to be hanging tight and not doing too shabby. Maybe that's where the focus will be. Any takeaways on that?
Yeah, we're seeing growth in footwear consumption continued to decelerate this year. Still growing, just growing at a slower rate. In fact, looking at shoe store sales, they are set to contract this year, kind of talking about that segment within the broader footwear spending. So we're still seeing that growth in footwear demand. It's just moderating. So headed in the right direction, just not nearly as robust as a lot of us would like.
I'll take not a counter view. I'll add some ancillary thoughts to that. I think the consumer, I think the politics, the current politics, kind of has something to do with this. But I think when you see a rate drop like that and you're trying to buy a home, that's really encouraging. I think there's a lot of psychological. I think more so than ever, maybe since 2008 when everything was flips upside down. I think people are looking at these rate cuts more than ever. Normally, when you have rate cuts or rate increases, right, it's a market mechanism. It's usually financial people looking at it, banks, companies, et cetera. But I think consumers are looking at this more than ever because of the housing crunch that people have, and people, who are younger, who want to buy a home, their first home, see this as a very good sign and maybe gives them some exuberance, maybe irrational exuberance if they're in debt, but exuberance nonetheless, that they're going to go out and make a purchase or spend. And as they're looking for a house, they've probably got a pep in their step to purchase an extra pumpkin spice latte, not just one, but two. So I think there's something to this at this moment in time where a lot of folks across the U.S. are actually looking at rate cuts. And if the Fed is forecasting more this year, I think 2025, as we head into it, depending on how people feel about the election falling out, can be an okay year. I mean, I think from a consumer standpoint, people are going to be they're going to be feeling a little bit better, not because it's the rate cut, to Gary's point, is going to like directly trickle down, but there's a feeling, right? If we have a vibe election, then we've got a vibe economy at the same time, and so I think that's something to look at too. Is I do think it helps people feel a little bit better about their situation. What do you think, Gary?
Yeah, certainly, I would agree. Looking at mortgage interest rates, they're the lowest in, my goodness, over a year and a half, upwards of 2 years. I think Freddie had said 15-year fixed at something like 5.15, and a 30-year fixed down to 6% now. Yeah. It's crazy to talk about down to 6% here a couple years ago. You could get a fixed for 2 and change, and now everyone's getting excited and wanting to refi because you can now get it down to 6%. So, again, that goes back to the bond market. The Federal Reserve does not directly control mortgage interest rates, but there's an indirect relationship, and it's the bond market I talked about earlier. And I think we're likely to see those interest rates drift a bit lower. And again, to your point, absolutely, those lower interest rates are going to free up a little more disposable household income that could be put toward lattes or that extra pair of shoes or whatever else. But at the same time, I caution, down to 6%. I mean, my goodness, here just a couple months ago, we saw the most unaffordable housing market on record, with, of course, values as high as they were and rates as high as they were. It's a really not a good time to buy a house at all. The situation is improving, but again, it's improving from a pretty bleak spot. And I think the mortgage situation will continue to improve. Rates will drift a bit lower. They won't plunge near like they have the last 6-9 months or so, but they'll drift a bit lower, and that will, I think, help free up more of that disposable household income I talked about earlier that can be put to other purposes like footwear.
I think we focus a lot on housing. If people don't realize, when someone buys a house, they got to fill it full of stuff. So that's like, for me, it's like the number one indicator, right? You buy a house or you upgrade from an apartment or whatever, you've got to buy a couch and all these other appliances and supplies. But for footwear, you get a bigger closet, so you get to fill it up a lot more than you did from your apartment. So there's a lot more space to fill up, and so I'll have that little comment there to look at just from a shoe standpoint.
Andy, one of the things that I've often been surprised at, or at least in the most recent few years when rates have been so high and you can earn more in a CD or a money market account, is that not everyone applauds reductions in rates, right? I have older people in my family on both my wife's side and my side that see that, and they have short-term investments. They're long on the tooth as far as kind of how much further they're going to be on this planet, right? And so their thought is like earning money on their cash or on those kinds of investments in the short term is more appealing. So when we're all cheering rate reductions and refinancing our mortgages, although I have a 2.5% rate, so it's going to be quite some time since I can refinance. not everyone in an economy celebrates these moves because of how it impacts investments, which there's not one kind of unified thought around how.
You're right.
The
No, totally. I totally agree. Fixed incomes, it's easy to take a 5% gain when it's sitting in an FDIC insured account, right? Like that's an easy win to take versus. But I'm guessing you're trying to get power of attorney so you can get access to the $7 trillion in capital so that you can steer it all into equities to grow your wealth eventually, correct?
I mean, I'm not the executor of any estate, so
you're not working hard enough, my friend. You're not working hard enough. Your snake oil isn't selling, okay?
I'm not the firstborn. That's the problem.
Well, there's ways to get around that. Old England, they'd have plenty of ways around that, my friend. Anyway, I guess to Gary, my question to Gary is, do you buy pumpkin spice lattes?
Oh, heck no. Wait, let's guess. Hell no. That's my guess.
I have to confess, I'm a producer, not a consumer.
So when we're talking about people getting so exuberant they buy 2 instead of 1, you're at 0. So you're actually, Gary is hampering the economy that he's actually tracking.
That's right. But I did marry outside my league though, so she's good to offset my deficit.
That's
unequally yoked.
Oh man, well, that's all right. Well, folks, we thank you for joining us today as we kind of like just look at what's happening, and I think some of this, hopefully, you're talking about in your company or at your dinner table. But these things are really important, and they drive us forward, and it's something that we need to consider as we look to supply and demand planning in our industry, and some of the consumer shifts that are happening. I mean, when we talk to a lot of footwear executives, what I always like to hear is the worry or concern about their consumer. And they say their consumer, right? My consumer does this, this, and this, right? And so I think that's really important to remember who we're serving and trying to add as much value as we can and figure out where they're going to be so that we can meet them where they are at any economic level with great footwear. And we appreciate you listening today and trusting us with 30 minutes of your valuable time to pontificate around things that we don't know anything about, except for Gary. But for Matt and me, we just show up and talk, and that, so that seems to be working out so far. No one's fired us. But
we are creatures of DC, man. That's what we do best.
Things do change. But anyway, so folks, thank you again. Shoeandshow.com is our website with all the episodes. Every Monday, a new episode drops. We appreciate you listening. We got some really great episodes coming out in the coming weeks on a bunch of different topics, and encourage you to go back over the next several months if you missed any. There's some really interesting shoe stories from leaders in our industry, as well as really important topics that are still very relevant, even though they may have dropped, in the summer or spring, still very relevant as we're heading into holiday season. So definitely go back and check that out. And again, every Tuesday at 2 p.m. for our members. FDRA members, every Tuesday at 2 p.m. we do a Zoom call, and Gary comes on and he does his dog and pony show on the environment.
Or dog and pony.
You're the dog, he's the pony.
No, it's the other way around.
I don't know what Thomas
is the jockey. I'm the jockey. Thomas is the pony, and Gary's the dog.
Okay. Well,
I don't know what John Pellegrini is. So. Hopefully
you'll still join the call at Tuesday at 2 p.m. to see what this circus is, at the very least, if not get information. But, exactly, join the circus. All right, folks. Until next time, Shoe-In is out.
Shoe-In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.